Imagine this. You wake up, check your bank app, your salary hit on time, same number as last year, maybe even a little higher. Coffee costs the same as yesterday, petrol hasn't jumped this month. News anchors say inflation is under control, and yet something feels off. You're working the same hours, producing more, being told the economy is stable, but your life feels tighter. Not dramatic, not collapsing, just quietly heavier. This is the part nobody explains, because your salary can lose value even when prices stop rising. And the reason isn't obvious. It's buried inside how modern money actually works. Let's slow this down. Right now, across the world, inflation headlines are calming. Central banks say they've done their job. Interest rates peaked. Price growth slowed. On paper, this is success. But here's the uncomfortable timing. Wages react late, always. Prices move first, then profits, then asset values, and only at the very end, salaries. So by the time prices stabilize, your paycheck is already outdated. Think of it like this. Prices sprint, wages jog, and you're told to be grateful when the sprint stops. But that's just the surface problem. The deeper issue is more subtle. Your salary is not designed to protect your buying power. It's designed to lag behind it. Let's rewind a few years. During high inflation, everything jumps. Food, rent, transport, insurance. Your company raises prices quickly because they have to, because competitors do, because customers adapt. Revenue adjusts fast, but wages? They're reviewed annually. That delay is not accidental, it's structural. Every month your raise is delayed, your employer effectively pays you less in real terms. No announcement needed, no confrontation, just math. Now inflation slows. Prices stop racing. The damage is already done. Your salary didn't fall, but your purchasing power already did, and now it's frozen at a lower level. That's how stabilization quietly locks in losses. But it goes further, because inflation doesn't hit everything evenly. The official inflation number is an average, a polite one. It includes things you rarely buy and underweights things you can't avoid. Housing, healthcare, education, transportation, these inflate faster. They always do. So even when headline inflation cools, your personal inflation stays hot. Your salary is matched against an average life, but you live a real one. Now here's where the system gets interesting. When inflation rises, central banks step in. They raise interest rates. This slows borrowing, cools spending, stabilizes prices. That's the story. But higher rates also freeze wage growth. Companies cut hiring, freeze raises, delay promotions. Labor becomes cautious money. Meanwhile, existing debts don't pause. Rent contracts stay locked. Loan EMIs stay fixed. Credit card interest quietly compounds. So stabilization doesn't feel like relief. It feels like pressure without movement. Then comes the irony. Asset owners benefit. Stocks reprice. Real estate holds value. Bond yields improve. People who already own things recover faster than people who earn things. Your salary is income. Their wealth is capital. Capital adjusts. Income waits. Now let's talk about the quiet math no one shows you. Say inflation runs at 8% for 2 years. Your salary rises 5% total. Inflation then drops to 3%. News headlines celebrate, but your real income is still down roughly 8 to 10%. Stabilization doesn't reset the clock, it just stops the bleeding. You don't go back to where you were, you stay lower. That lost ground becomes the new normal. And this is why low inflation doesn't feel good anymore.
because it arrives after the transfer already happened. From wages to prices, from workers to balance sheets, from income to assets. Slow, legal, invisible. There's another layer: productivity. You're told productivity gains raise wages. In theory, yes. In practice, productivity gains now flow differently. Automation, software, systems. Your output increases, but your negotiating power doesn't. Because productivity is no longer tied to your effort. It's tied to infrastructure you don't own. So the surplus goes elsewhere. Your salary reflects replaceability, not value created. Now combine everything: inflation shock, delayed wages, rate hikes, asset recovery, productivity detachment. You get a world where prices stabilize, but life feels permanently more expensive. Not because things keep rising, but because your reference point shifted. You didn't notice the moment it happened. There was no announcement, just fewer small freedoms. Skipping one extra subscription, thinking twice before travel, delaying purchases that used to feel automatic. That's not lifestyle creep in reverse. That's purchasing power erosion, and it's sticky. Here's the part people don't like hearing. Even if inflation stays low for years, your salary does not automatically catch up, because companies benchmark raises forward, not backward. They don't compensate for lost years, they price future risk. So past inflation becomes permanent damage. Now zoom out. This isn't a failure of any one government or one company. It's how modern monetary systems absorb shocks. They protect stability first, growth second, wages last. Because wages are politically sensitive but economically flexible. They can fall silently without a headline. That makes them the pressure valve. And when the valve releases, it rarely resets. That's why older generations say things used to be easier, not because life was cheap, but because wage-to-cost alignment was tighter. Now it's stretched, and once stretched, it doesn't snap back. So when you hear prices have stabilized, translate it properly. It doesn't mean relief. It means the system has accepted the new baseline. Your salary didn't lose value overnight. It lost it gradually, quietly, and legally. The question isn't whether this will reverse. The question is simpler. In a system where stability locks in losses and recovery favors assets over income, what is your salary actually anchored to anymore? And if it's not anchored to your cost of living, what is it really measuring?